Well, no doubt there are global headwinds, and arising from the geo-economic fragmentation in the past, as well as now a lot of trade actions, especially by US. Now, India is, of course, as you know, that also dealing with that in terms of bilateral trade agreements that are being negotiated by the two countries. Besides, there are a lot of resilience that India has shown, and there are certain pillars of support for that resilience. One is a good economic growth, consistent economic growth. In fact, India remains one of the fastest growing economies among the large economies. The second is that you have low fiscal deficit path which is on the declining trend. You have a low current account deficit. You have a low external debt. And we have twin problems already sorted out earlier of the corporate balance sheets. So corporate balance sheets as well as the bank balance sheets are in healthier trajectory. The strategy, government policies which have aided capex, the capital formation, that investment growth. So all these things have led to situations where there is a consistent support to industry and services, and therefore I would suggest that despite the global headwinds, India is in a reasonably good spot. The retail investors are fairly strong in Indian capital markets, in my opinion, sometimes much stronger than elsewhere. And they have, I believe, the trust. And of course, many of them who are newly entered may not have encountered the downturn, which happened. They have not seen the volatility. In some ways, they were only seeing the markets up and up. But the markets go up and down, and so the situation is that there's a learning curve for them as well. But then the advantage in capital market is to stay long-term invested, to stay invested for long term, and therefore that's the if that's the strategy that they adopt, they would definitely be in a much better position rather than getting panic over this short-term thing. As you would have noticed also, the things went down and things have also recovered in the meanwhile from what it was. The September 24 we had the fair thing, and there itself we had those corrections which happened, and subsequently April 2 onwards, as you know, although there was a very big decline in many other bourses, in our case the decline was 3 to 4%. Not as much as 9 to 10% elsewhere. So that is something which they have seen and they have encountered, and I believe they must also invest with the proper information. Awareness is needed, and when they are going into the F&O markets, they must be cautious, because our study itself showed last 2 years that 9 out of 10 small investors lost money, because you have to understand that market, how to intervene. And this market is for hedging, for price discovery, and it's not market for short-term trading. Because we use it as for short-term trading, especially the distortion which was there in terms of index options on the expiry day. And there, you are making yourself very predictable. You're trying to say that, okay, so what? If there's a small money we will lose because the premiums are really small at the time. But then that's not a kind of a way one should be really looking at markets. One should do a fair thing. What's your objective? The objective should not be to play casino. The objective is to be an investor. And I think that is what my appeal to them as well. I think Sebi had taken some measures, and those measures to some extent were effective in terms of that the volumes, the open interest came down something like 30% or 1 year to year. Although if you look at from 2 years down the line, it was still up. It was still up. The premium were also down about 15%. So some cooling off, and I think we are taking up through a consultation paper, some reforms of the metrics and some suggestions, and a lot of comments have been received, and we'll take a considered view.